Hello and welcome to the Huntsville I2C 101 Bootcamp Series. Today we're going to be talking about financial statements. First of all, I am Roger Spain. I'm with Warren Averett CPAs, a CPA firm that is located throughout the southeastern United States. And I am with the firm's group that provides outsourced accounting services to businesses of various sizes. And I offer that to you primarily so that you'll understand and have an understanding of the perspective that I bring to the discussion. We're going to be conducting a series of studies across many topics, and we're going to begin with some of the most basic, which is understanding financial statements and what those components of those financial statements are and how to use them. I promise that I will try to make this as exciting as I can, understanding that the topic is still accounting, and we'll do what we can to make it interesting. The goal of this first course is going to be to discuss financial statements and the basic components of those, and we're going to break that down really into two presentations. We're going to start with the income statement and balance sheet, as you see on the title slide. So with that, here's the agenda for this first segment. We'll be talking about financial statements. What are they? Why are they prepared? When are they prepared? How often? And who prepares them? As I mentioned a minute ago, we're going to be talking about the income statement and balance sheet first in this video, and we're going to move then to the statement of cash flows and the notes to the financial statements next. So first of all, let's go through all four of those components of a basic set of financial statements. What are financial statements and what are those components? First is the income statement, and most people are very familiar with an income statement. Many people also call it a profit and loss statement. They're really the same thing. We start with income, we then show expenses, and ultimately we get down to net income or loss, hopefully net income. And I like to tell people to think of the income statement as a movie. It reflects what has happened over a period of time. So when you watch a movie, you get to see activity for some period of time as that movie takes place. So think of the income statement as a movie. What has happened over some specified fiscal period or period of time. Then we talk about the balance sheet. The balance sheet shows the assets the company owns and who has claims on those liabilities or who has claims on those assets. The balance sheet is as of a point in time. Think of it as a photograph. It presents the financial position of an entity at a specific point in time, showing what its assets are and who has claims on those assets. So think of that as a photograph. Then we talk about, in the next video, the statement of cash flows. The statement of cash flows is similar to the income statement in that it presents activity over some fiscal period, over some period of time, but it presents that information instead of in the conventional income less expenses. It presents that information really on a cash basis only. It shows, the statement of cash flows shows how a company obtained and used cash during the same period as the income statement. I like to say it's maybe like an indie movie. It's kind of the same idea, but it's presented a little bit differently. Last are the notes to the financial statements. The notes to the financial statements simply explain many of the details that are pertinent and applicable to what a reader might want to know to gain a deeper understanding of the numbers that are in the financial statements in those first three statements that we discussed: the income statement, the balance sheet, and the statement of cash flows. So those are the four components of basic financial statements. The first two we're going to talk about in this video segment. The next two, the last two, the statement of cash flows and notes, we'll talk about in the next video. With that, let's talk about now perhaps what are financial statements? And just to give you a quick definition that I've come up with is that financial statements are there to inform the reader or user of the financial statements of the financial position and results of the company as of and for a specified date or period. Simply, where is the company today and how has it been doing over some recent reporting period? That's what financial statements are intended to show to the reader. When are they prepared? Well, that depends. Internally prepared financial statements are usually prepared on a monthly basis, could be quarterly, semi-annually, at least annually, and external users might want to see financial statements annually. However, in many cases, there are borrowers or investors who like to see financial statements more frequently, perhaps quarterly or even monthly. Who prepares the financial statements? Management is responsible for its own financial statements. Management prepares the company's financial statements, and it has to take ownership of those. Now, management can use a CPA to assist them in the preparation of those financial statements, and that's great and fine, but don't for a minute forget that ownership of those financial statements really belongs to management or ownership, if that's the same group. Next, I want to present to you very briefly, before we get into the components of financial statements, a couple of terms that might be important for everyone to understand. There are different levels of opinions that companies may call upon a CPA company or CPA firm to provide relating to its financial statements. And I've shown them here. They are compilation, review, and audit. And I've shown them following the hierarchy of the level of assurance that a CPA provides relative to those financial statements. In a compilation, the CPA provides no assurance that the numbers are accurate. The CPA simply says and puts an opinion on those financial statements saying, these are management's numbers, and I've assembled them in a manner consistent with the way one might normally expect to see financial statements presented. Next is a review, and in a review scenario, the CPA will offer an opinion, to paraphrase, that goes along the lines of, well, I've looked at these financial statements and I'm going to provide negative assurance that, in other words, provide assurance that nothing came to my attention that causes me to believe that they're materially misstated. And then last is an audit. An audit provides the highest level of assurance. It does not, however, mean that those financial statements are correct to the penny. The auditor or CPA in that case will provide an opinion that says, basically, we've looked at these financial statements and they are free of material misstatement. In other words, they may not be correct to the penny, but when the reader reads these statements, they're close enough to give them a reasonably accurate idea as to what the financial position and results of the company are for the period reported. So those are important terms to keep in mind as you think about financial statements and how they're presented and what sort of opinion may be attached to them. Now, we're not going to do much math, I promise. Hang with me, but there are a couple of important equations we want to talk about, and I'm going to tell you that some of these we're going to cover later, because today, or in this segment, we're only going to cover the basic components of financial statements, not how to prepare them, but just maybe how to read them and what they show the reader. Some important equations to keep in mind as we move forward through our classes or through these videos are: one, double entry bookkeeping means that debits equal credits. Double entry bookkeeping simply means that for every transaction there are two entries, one that is a debit and one that is a credit, and they equal one another. It's a zero-sum game. And that's how we know that books are balanced, because we always net to zero. And if we don't, we didn't do something right. So double entry bookkeeping is a great way for us all to know that we've recorded all transactions appropriately and correctly, and that the books are in balance. The next equation that's very important is relative to the income statement. It's the easiest one on the page, and I think most all of us already knew it anyway, which is income less expenses equals net income. That's where we're going to focus today, along with the balance sheet. This one might be new to some people. Assets equal liabilities and owner's equity. Simply stated, when you look at a balance sheet, it shows on the left side the assets of the entity, and on the right-hand side, it shows claims on those assets. If they're liabilities or claims from third parties, those are claims on the assets. And then whatever's left after those third-party claims are owner's equity or owner's claims on those assets on a net basis after third-party claims. But assets always equal the cumulative claims on those assets, being third-party claims and owner's equity or owner's residual claim. Let's quickly walk through the beginning of a company trying not to get too hung up on debits and credits, but working toward financial statements so that we can see what an income statement looks like, how it's constructed, how to read it, and then do the same for the balance sheet. And in subsequent videos, we'll get more into actually how to do some of the accounting work. Very quickly, if you were to start a business, in this case, we're going to call it our business. You might invest $1,000 in the new business. And when you do that, you have $1,000 in assets because you put $1,000 into the company. So its assets are $1,000. Who has a claim on that $1,000? Well, we just started the company. There are no third-party claims yet. So owners have a claim on that $1,000 that they just put into the company. So at this point, it's easy. We have $1,000 in assets, and the owners have a claim on the $1,000 that they just put in because we have no third-party obligations at this point. Quickly now moving to the income statement, and what I want to focus on here is presentation and how to read an income statement. We'll get into how to populate and how to put data into the income statement later, but for now we're going to talk about what is the income statement. Well, it's presented for a fiscal period, as we talked about earlier. It could be a month, a quarter, could be 6 months, could be a year. We're going to assume that what we're talking about here might be the first year of operations of our business that we just talked about putting $1,000 into. So we go through the year, and whatever it is we're selling, we're doing something to generate revenue, and we have sales of $1,800. I made that number up, so follow with me. We then subtract out the cost of goods sold. So we had to either make or buy whatever it is that we sold, and we deem those to be cost of goods sold. Backing out cost of goods sold from sales gives us our gross profit or our gross margin. It's a very important term, and you'll see other businesses present this in their financial statements, and this is a common way to present the income statement. Next, typically, we show the operating costs of a company. Those might be selling and general and administrative expenses. It could be several other types of expenses, but for ease, I've just shown here operating costs as those. And those are then subtracted from the gross profit or gross margin. And that gives us the operating income before taxes, which is the line showing $250 in this case. So now we've had sales and cost of sales, and now we've backed out operating expenses, and we show operating income. After operating income, we're going to show the non-operating expenses of the company. Those could be taxes, they could be non-recurring expenses, they could be unusual items, and we back those out as expenses after we show operating income. That gets us to net income, the amount of money that the company made for the year, which is all revenues less all expenses. And in this case, that net income is $110. The important thing I want everyone to understand here is that this is the common presentation for an income statement, where we work through sales and cost of sales, then through operating expenses, then through non-operating expenses, and that gets us to net income. Now let's move our focus over to the balance sheet for the remainder of this segment, and then we'll move in the next segment over to statement of cash flows and notes. When we look at the balance sheet, and by the way, I apologize, we're going to do algebra, but only for 1 second, so hang with me. It'll be easy, I promise. Assets equals liabilities and owner's equity. We talked about that a minute ago. The assets of the companies, of any company, has claims against those assets. Those could be third-party claims, such as accounts payable or notes payable to a bank. And whatever's left after those third-party claims are satisfied is owner's equity or owner's claims to the assets of the company. So in the second presentation of this same equation, I've simply used a little algebra to show you that assets minus third-party liabilities is equal to owner's equity. It's the same idea. We just did a little bit of tricky algebra. As we look at the balance sheet, I told you that you can think about assets being on one side and all of those claims being on the other. In this case, ignore the numbers for just a moment. The important thing is the presentation and how to read the numbers and the descriptions that are on the balance sheet in a typical presentation. So you see the assets where we work from the most liquid assets, that being cash and inventory, things such as that. down to the less liquid assets, in this case being things like equipment. If the company had bought a computer during the year, that's less liquid than cash, certainly, and even inventory or accounts receivable. We then total all of the assets up, and in this case, we have total assets of $1,710. Well, who has claims on those assets? Well, as we look at the right side of this equation, we see that first we look at liabilities and third-party claims. We owe accounts payable to vendors of $100, and we borrowed some money during the year from the bank, probably to buy that equipment, and we show that as a liability as well. Those are the third-party liabilities. What's left over is $1,110, which is simply the total assets of $1,710 less third-party claims of the liabilities of $600. That means that our owner's equity is $1,110. When you total those up on the right, the liabilities and the owner's equity, it's $1,710, and it's balanced against the assets. Because if the two numbers didn't agree, we would have to change the title to unbalanced sheet, and no one wants to read one of those. So the balance sheet does balance in this case. Assets equal liabilities and owner's equity. Those are the basic financial statement, two of the important components of basic financial statements. In the next video, we're going to talk about the statement of cash flows and notes to financial statements. I hope this has been helpful and a great introduction to get started into what financial statements are and how to read them. And ultimately, if you hang with us, we're going to move forward into how to prepare financial statements.